look at the bigger picture with Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial. Ed, thanks so much for joining us. Really appreciate you being here.
Well, thanks for having me.
So we're looking at a mostly higher market today, higher on the week at least. So there's some optimism heading into next week's Fed meeting. What are you expecting, Ed? A hike, a pause, or a skip?
You know what? I think there's enough economic data out there right now that's showing that the Feds could pause. Everything that's coming out right now is really what the Feds have been wanting to justify a pause, but it could wind up being a skip, depending on what the numbers are, for the July meeting. But even if it is a skip and there's one more raise, I think that's going to be the last one. The economy is slowing down. We're seeing that as far as the types of jobs that have been lost versus the types of jobs that have been gained. We're seeing it with the consumer credit numbers, hitting, over $1.25 trillion in credit card debt. Default rates are higher. So, the Feds are going to look at it and say, what we're doing is working. So, now may be the time to pause.
So either way, no hike come next week in terms of your view, but this pause versus skip could possibly mean a skip, obviously meaning just skipping the June meeting and then hiking again in July. You talk about the data, though, heading into that. Obviously, we get CPI and PPI next week, but are you most focused on the jobs data to really know what the Fed does in July?
For right now, because that's what we have. And, it really determines on the Fed's outcome is going to be how they interpret the data, and once the CPI comes out next week, I think that's going to have a big effect on the outcome. But again, all the data going into this is showing a slowdown. So, I think that may wind up being the icing on the cake that they need to say, we're going to take a pause.
It's showing a slowdown, but to put that into perspective, the labor market clearly slowing, but still pretty strong, still pretty resilient. Yes, we did see an uptick in initial jobless claims. Let's see if those continue in the weeks ahead. But there's a lot more talk of potentially skirting or avoiding a recession, a lot more soft landing scenario talk kind of being brought back into the marketplace. Do you think we can avoid a recession at this point?
I don't know. Originally, early on in the year, I thought we were going to have a pretty deep recession, but, just out of sheer will and spending and everything that the, American consumer is doing, it's almost out of sheer will that we're going to, avoid a deep recession. I think we're going to have a mild one. And if we see it, it's going to be towards the end of the year. But it's going to be probably more of a bump in the road the way that it looks right now. But again, it's really going to depend on what the Feds do. If they raise rates and continue to raise rates, it's going to be pretty painful. If they do pause and maybe just do one more raise at only 25 basis points, I think we're going to be okay.
So as I said, the major averages are higher on the week heading into that meeting. How much of this rally do you think rests on the Fed actually pausing?
Well, that's a great question because, when you look at the S&P 500, it's up. We're in bull market territory officially today. Which is great. I'm very cautiously optimistic, though, because when you look at the data, only 20 companies out of the 500, that means 480 companies are not positive this year, and only 20 are. And so it's those 20 companies that are making up that gain. So, and it's a very thin line, and it's the same thing with the NASDAQ as well. So it's a very narrow corridor for those companies that are being successful. But the market is a very good leading indicator as to what's to come. And, once we hit that bull market going in, that's a good sign as to where the economy's going and how long, if we do have a recession, how long it's going to last.
Yeah, the rally's certainly been pretty skinny in terms of the S&P 500. But aside from today, the Russell is off less than 1%, but seeing, pretty substantial losses today, but overall higher on the week. So we're starting to see some small cap participation. Do you take that as a bullish indicator?
I do. That's a really good sign because, the small caps, that's the lifeblood of America, right? Small business. And so to see small business start to rally, that means that, Americans are getting comfortable. They're starting to reinvest some of their savings back into small businesses, reinvestment. So that's a really good sign. But again, I'm being very cautiously optimistic right now. And but it's a good sign of things to come.
So you've said you're cautiously optimistic a few times. What does that mean in terms of how you're actually investing your money? How are you putting your money to work right now? Or are you keeping it on the sidelines and taking advantage of some of those higher interest rates for cash?
Actually a little bit of both. We've had a large cash position most of this year, and we've slowly been redeploying that capital, over the last 60 days. And we're going to continue to do that. And that's what I mean as far as being cautiously optimistic. I don't think now is the time to go all in. But you don't want to be all in cash. You don't want to be all in the market because you don't want to miss any gains. But, if we're wrong and the market goes the other way, you definitely don't want to take a bath either if you're already sitting in cash. So, slowly redeploying some of that capital for us is really, really important. And, we're looking at those companies that have very, very strong balance sheets. That's really what we like right now. And a lot of those companies are those top performers right now in both the S&P and the NASDAQ.
So can you be any more specific about how you're redeploying that capital outside of just looking for quality names? Any specific sectors that you like?
Believe it or not, it's not exciting, but I like manufacturing. I like a lot of those sectors that have taken a really huge hit last year. And, we're focusing a lot on manufacturing right now because it has taken a huge hit. And again, even though the PMI was down, I think those are going to be some really good buys going forward.
So finding value in manufacturing, are you comfortable putting money to work in big tech right now? Any of these AI plays are too expensive at this point?
I think now, like NVIDIA, I think it's overbought. If you're not already in, I think it might be a little bit expensive to get in. Same thing with Apple and Microsoft and even Google. But, any of the AI, and that's a really, really good play right now. If you're in, I would hold it and incrementally kind of continue to go in and watch it on the dips. Just like NVIDIA, it was up over 400, it's back down, and take advantage of those dips a little bit. But again, be very cautious when you're going in.
Yeah, NVIDIA off about 0.5% this week, up higher today, but man, up almost 170% year to date. Ed Siddell, CEO, Chief Investment Advisor of EGSI Financial. Thanks so much for joining us.
Oh, thanks for having me. Have a great weekend.
You too. Appreciate your picks.